This is Lecture 5, Accrual Accounting. We've been talking about how to create journal entries, how to post to T accounts, and in general, the rules of accounting, but I haven't actually told you what that system of rules is called. Right? The system of rules that we are learning about in this class is called GAAP, which stands for Generally Accepted Accounting Principles. Now, this is a set of rules that people have to follow in order to prepare their accounting information. Why do they have to follow it? Well, if they don't follow these rules, then the auditors cannot give them a complete approval of their financial statements. So all of the companies listed on public stock exchanges are required to have audited financial statements. And if the auditors come in and they see that the company is not using GAAP, then they can't fully approve those statements. And then everyone says, hey, the auditors aren't approving their statements. And you can imagine how that goes from there. So that is the power of these rules, is that if companies use them, then the auditors will fully approve their statements. And of course, that is what makes pretty much everybody use these rules. So unless you're talking about a very small startup or something, pretty much all the companies in the US are using GAAP. So that's what we're learning in this class. Now, GAAP requires that we use a form of accounting called accrual accounting. And accrual accounting essentially means that we're going to record revenues and expenses whether or not the cash has been paid. What's important when recording revenues is that they're earned, not that we've collected the money. And what's important when recording expenses is that they've been incurred, that benefits have been used, right? Whether or not we've paid for those benefits yet. And we've seen that already through some of the transactions that we've done. We just haven't formalized it so far. Now, accrual accounting is based on two major principles. The first one is revenue recognition. So revenue recognition says that we record revenue when it has been earned. So in other words, when the company has completed its part of the agreement, when they've done what they promised to do for the customer. And the second part is that we record the amount of revenue that the company expects to receive. Okay, so let me give an example to explain these concepts. Let's say that you need a textbook, and your friend says, hey, I found this great new site, textbooks4cheap.com. I even have a coupon code to give you 10% off, and they'll ship you your books. And the best part is they don't even charge you until they know you confirm that that's the book you need for your class. All right, so let's imagine we're this new business, textbooks4cheap.com. So I make an order, and the company receives the order. All right. Next, what happens is that order is sent to the warehouse. Now, if this is a small company, right, there's one warehouse, that's a pretty simple thing. If you're a big company like Amazon, you have warehouses all over the country. And especially if you're trying to do some kind of fast or free shipping, right, you want to send the order from the warehouse that's closest to the customer. And of course, as the customer ordered multiple items, then it becomes some kind of maximization problem, right? What's the closest warehouse that has all of those items that is near the customer? So it can be more complicated with bigger companies. With a small company, it's pretty simple. One warehouse, we send the order. Now, once the order gets to the warehouse, the order is picked. Now, picked means that somebody called a picker goes around the warehouse and literally picks out the items in your order. Now, if you only ordered one item, that's pretty simple. They go fetch that one item. But if you ordered, say, 10 items, they have to go around and get every single one of those items and collect them together. If you've ever ordered a bunch of stuff online and you've gotten a packing slip, you might have seen like little tick marks or something next to each of the items. that was the picker, right? Going through and saying, yep, I picked up that one, I got that one. Okay, so your order is picked out from the warehouse. Once all your items are collected together, the order is packaged. And so that means it's put in a box, right? And it's all put together. All right, once the box is there together, then the order is shipped. Now, for something like Amazon, at the time your order is shipped, your credit card is charged. But for this company, I made an exception. I said, hey, they're not going to charge you until you've received the book and confirmed it's the one you need. The reason I did that is because for corporate customers, when we have companies selling to other companies, often they're a little more lenient than they are with individual consumers like you and me. So with a corporate purchase, often they won't charge at the time of shipping. Instead, what they'll do is they'll just get a whole bunch of shipments, like say for the month or for a week, and then they will bill those all at once after the fact. So let's go with that kind of example. So let's say the order is shipped, and then the customer receives the order. And then after the customer receives the order, the bill is sent. And then the customer receives the bill. And then the customer pays the bill. So you can see that even for a relatively simple business, there are a number of steps that have to take place in order for the company to complete the process. Now, if you take a company that's reasonably active, you can imagine that on any given day, they have 10 or 100 or 1,000, or a company like Amazon, multiple thousands of orders that are somewhere in this process. So if we pick a day and we say, hey, this is the year end, we have to determine which of the orders that are in this process are revenue. So we need to know at what point is revenue earned, because every order that has reached that point is revenue, and every order before that point is not yet revenue. All right, so let's go through this again and think about, has the revenue been earned? So, do we earn revenue when we receive the order from the customer, when it's sent to the warehouse, when it's picked, when it's packaged, when it's shipped, when the customer receives the order, when the bill is sent, when the customer receives the bill, or when they pay the bill? All right. Typically, I find most students feel that revenue has been earned when the customer pays the bill. But that's not correct. That's because we have to look at the revenue recognition principle here. We record revenue when it has been earned, and it's earned when the company has completed its part of the agreement. Okay, what did the company agree to do? They agreed to send the items in the order. So when did they complete their part? At the time the order is shipped. Right? That's when revenue is earned. Think about it this way. Suppose for some reason the bill was never sent, right? Would the company still be entitled to collect money from the customer? Yes, they would, right? What if the customer never receives the order? Well, then that's an issue with the shipping company, right? But the company itself has completed their part of the agreement once they ship the order. So that's when we record revenue. And of course, since the customer hasn't paid yet, we will still record the revenue, but it will be accounts receivable. So this is what happens with revenue recognition, right? We figure out when the company's done their part and we record that revenue then, even if the customer hasn't paid yet. Okay, the second part says that we record the amount of revenue the company expects to receive. Well, let's say that the book costs $200. But remember, your friend gave you a 10% off coupon. So are we going to record $200 of revenue? No, because that's not what the company will receive. Your friend gave you a discount of 10%. So you're only going to pay 90% of the price, which is $180. So that's the amount of revenue that would be received, right? So that's what the second part says. All right, now I said there were two principles upon which accrual accounting is based. The first one is revenue recognition. The second one is expense recognition. So expense recognition says that expenses are recorded when they are incurred, and they're incurred when they are used to generate revenue. Now, most companies have a lot of expenses, right? Take something simple like going to get a cup of coffee at your favorite coffee shop, right? Let's say you go get your favorite coffee. It's one of those slightly fancy ones, so you pay $5 for the coffee. All right, the company has clearly earned $5 of revenue because they've given you the coffee and you've even paid them for it. Okay, but what costs did they have to incur in order to give you that coffee and earn the revenue? Well, there's the obvious stuff. They had to buy the coffee beans, right? They had to buy all the flavorings and other things that go into the ingredients in your coffee, right? They had to pay for the cup. They had to pay for that little cardboard sleeve so you don't burn your fingers, right? They had to pay for the lid or any napkins or anything like that that you use. All right, let's go a step further. They had to pay for their employees, the person at the register taking your order, the person making your coffee, and maybe there's another employee in the back room, right, dealing with the inventory or cleaning the bathroom. They also had to pay for electricity to run their store, to run their machines. They had to pay for water. They had to pay for the internet service that's in there so that people will come in to buy stuff, right? They have to pay rent on the space where the store is located. All kinds of costs are involved. Now, all of those costs are necessary in order to be able to earn your $5 of revenue. It doesn't seem like they're earning very much when they have to pay for so many things. But of course, it's not just your $5. There's usually a line out the door at these coffee shops, right? So everyone is paying $5 for coffee. So they're generating all kinds of revenue with those costs that they spend. Now, let's say that the company is doing their income statement for the month of September. All right, so in the month of September, they're going to show all of the revenues that they earned, all the coffee they sold. Now, employees had to work in September, and when they worked, they earned that revenue for the company, right? By working, they helped serve the coffee. But let's say the employees who worked in September, they're not going to get paid until October 1st. So that salary expense, does it belong in September or does it belong in October? Well, the answer is it belongs in September because that's when they did the work and earned the revenue. Even though they're not paid until October, when was the work performed and when was the revenue earned, right? Same thing with the rent. Rent is usually paid in advance. So they paid September rent at the end of August. Does that mean that that rent is an expense in August? No, because it was September rent, and September is when they occupied the premises and earned that revenue, right? So the expense is recorded when it's incurred, when it's used, when it generates revenue, whether or not it has been paid. All right, so what does that mean? It means if you look at an income statement, on that income statement are revenues minus expenses. Now, the revenues at the top were 100% generated by the expenses listed below. And the expenses listed below were 100% used to generate the revenue above. Now, by being very strict on this and being very, very careful to match those revenues and expenses together, what that means is that we have the most accurate calculation of profit. right? If I'm putting August, I'm putting August expenses into September, then that's not a very accurate profit calculation for September, right? I need to segregate the revenues and expenses to the time period where they belong so that I can accurately calculate net income or profit in that time period. So that's why all this is necessary, to figure out exactly what the right time period is. It's so we can have that most accurate profit calculation. All right, so what I'd like to do in today's lecture is I'd like to talk about those situations where we have revenue or expenses, but the cash is at a different time. Okay? So I can summarize this in a table. We're going to talk about revenues and expenses, and in each case we can have the cash coming before the revenue or expense, or we could have the cash coming after the revenue or expense. So let's do an example with cash after revenue. Okay, so a company earns service revenue of $50. The customer promised to pay the following week. All right, we've seen this before. We've been doing journal entries like this for a while now. So what's involved, right? Well, service revenue is involved. If they're earning revenue, then revenue is increasing, and increasing revenue is a credit. So we're going to have a credit to service revenue. And of course, the customer has not paid. They're not paying till next week. So that means instead of cash, we have accounts receivable. And accounts receivable is an increasing asset. So that is our debit. Okay. So what do we have if we earn revenue, but the customer hasn't paid yet? Right? We have accounts receivable. And another name for accounts receivable, it's kind of a fancy name, is accrued revenue. So this is essentially a fancy term. Sometimes accountants like to use fancy terms, and they do that because it makes them feel important. If you start looking like you're understanding too much what the accountant is doing, the accountant feels like they're not so useful anymore. So that's when the accountant will start to pull out fancy terms and talk about accrued revenue instead of accounts receivable. So you always know that an accountant is putting on airs or being fancy or trying to impress you when they use terms like accrued revenue. But you can see where it comes from. It comes from accrual accounting and the revenue recognition idea. Okay, let's go back to cash after revenue. Let's finish that example. Let's say that the $50 was collected from the customer. So what's that journal entry? Well, we're collecting the $50, so we're collecting cash. So cash is going to increase, which is a debit. And then the accounts receivable is going to go away. So we're going to decrease accounts receivable, and that's another asset, so that will be a credit to accounts receivable. Okay, so that's something we've seen before, pretty simple. But let's talk about the other side of it. That's something we haven't really discussed. What happens if we have cash before we have revenue? Now, I know it may seem weird. Why would somebody pay for something before they get anything, right? Why would a customer pay in advance? Well, there are certain industries, certain businesses where it's very common for customers to pay in advance. For example, if you've ever gone to a concert or a sporting event and purchased a ticket, you paid for in advance, right? You paid for your ticket, and maybe you had to wait weeks or months until the event. And the company didn't earn the revenue until you went to the concert or the sporting event and you watched the show or the game, right? That's when they earn the revenue, but you paid for the ticket well before that, right? Another example would be something like a streaming service, right? So you will pay in advance for a month of streaming service. So let's say you want to subscribe to Netflix, you're going to have to pay for that month in advance, and then you get to watch for a month. Right? Even your tuition at San Jose State. San Jose State is a nonprofit, but you're still paying for your tuition at the beginning before the semester even begins. And then in return, you get to attend classes and you get to learn for the following months, right? So there are certain businesses where it is common for customers to pay in advance. All right, so let's use that video streaming example and look at example 2. An online video streaming service received $24 cash in advance from a customer for 12 months of their service in July. All right, so the customer pays $24 in advance for our service. So let's do this from the company's point of view. What's one thing that's going to be in the entry? Well, obviously, cash. They're receiving cash, so they're going to increase or debit cash. All right. Now, is the credit going to be revenue? Well, in order for the credit to be revenue, the revenue has to be earned. That means the company has to have done their part. So has this company earned the revenue? No, they haven't even started, right? It's a streaming service. They have to provide access to the streaming service. They have to provide the content in order to earn the revenue. So they're not going to fully earn that revenue for 12 months because that's how long they've promised to give that. So what we have is not revenue. Instead, it's something we call unearned revenue. So that word there, unearned, that's what tells you this is not real revenue. It's revenue that hasn't been earned, so it's not going to show up on the income statement. In fact, unearned revenue, it's not real revenue, right? Hasn't been earned. It is a liability. So why is it a liability? It's because it's an obligation. And remember, that's the definition of liability. By accepting the cash, the streaming service has an obligation to provide that service to the customer. Now, suppose there was a problem. Suppose they got the $24 and the next day something happened and they had to go out of business. What would they have to do with the $24? They'd have to refund it, right? So that's why unearned revenue is a liability, because by accepting that money, the company is accepting an obligation to either provide the service that they promised, or if they can't, to provide a refund, right? So the unearned revenue is a liability. Okay, now let's go a little further. Let's say that the subscriber watches the streaming service for 1 month. Okay, now it's a 12-month contract, but they've watched for 1 month. Has the company earned any of the revenue yet? Yes, they have. They've earned 1 month's worth, right? Now, it's not a whole lot, but they have earned a small piece of the revenue. Think about it this way. Suppose the subscriber watches for 1 month, and then the company goes out of business and they have to give a refund. At that point, are they going to refund the whole $24? No, they're not, because the piece they don't refund is the piece that they've already earned that still belongs to them. Right? So after 1 month, even though it's not the whole 12, they have earned some of the revenue. So what we're going to do is we're going to record that revenue. And remember, revenue always increasing. That's going to be a credit. So we're going to have a credit to service revenue. The debit is going to be to the liability, unearned revenue. We're going to decrease that unearned revenue liability. Okay? So we set up the liability here, and then as we earn the revenue, we decrease it. Now, where did the $2 come from? I know you probably already figured it out in your head, but this is a pretty simple setup. Let's formalize where the $2 came from, so in a more complicated situation, you'll be able to repeat that. Okay, the $2 is actually the $24 total that was paid divided by 12, because It was a contract for 12 months. And we multiply it by 1 because there has been 1 month that has been earned so far. Okay? So the company has earned 1/12 of the $24. Now, imagine that this company does this journal entry every single month. After 12 months, how much unearned revenue, how much liability is going to be left? Well, if we've done this 12 times, there will be nothing left here. All this $24 will have been debited away. And how much service revenue will have been earned? Well, if we do this 12 times, it'll be 12 times this or the whole $24. So essentially what we're doing every time we earn the revenue is we're transferring from the liability into real revenue that shows up on the income statement. Okay, so that's ideally how it's supposed to work. I'm sure you won't be surprised to learn that it's not always that pretty in the real world and not always that simple. So imagine a company like Netflix or any other streaming service, right? How many different customers do they have? Do all of those customers sign up on the exact same day? Do all of those customers pay the exact same price? Right? The answer is no, right? So we have customers starting on every day of the month, and those customers are all paying a different price based on the type of service to which they're subscribing, based on the length of time for which they're committing to subscribe, all kinds of things. So technically, what we're supposed to be doing is we're supposed to be doing this entry individually for every customer every time each customer has their 1-month anniversary. All right, so for a company like Netflix, that's going to be maybe a couple million entries every month. Now, do you want to be the accountant doing that entry millions of times every month? No, I'm sure you don't. Most people wouldn't. But here's the fun part. That entry, even though it's different for every customer, it's exactly the same every month for that customer. It repeats. Now, when journal entries repeat, accountants tend to get bored, right? If all we're doing is journal entries and it was the same one over and over again, oh, that's so boring. I don't want to do that entry again. It's just going to happen again next month. Why should I do it now? I feel the same way when I have to clean my house. I hate cleaning my house. So I'll be like, why do I have to vacuum this week? It's just going to get dirty in here again. I'm going to be vacuuming again next week. What's the point? Or maybe you do the same with your homework, right? Hey, what is this homework assignment this week? Teacher's just going to give us more homework assignment next week. I don't want to do it. I'm just going to wait till later. All right, so you can understand how these attitudes come about, hopefully not with your homework, but with certain things. And that's often how accountants feel about entries like this. So what happens in the real world is if we have an entry like this that has to happen every single month, most of the time, most companies will get bored of doing it and they won't want to do it. So they will let it slide and they'll let it slide and they'll let it slide. Now, if I'm cleaning my house and every week I'm letting the vacuuming slide and I say, I don't want to do it, I don't want to do it, one day the dust bunnies are as big as tumbleweeds, right? And they're rolling around the house and I say, okay, I have to clean, I have to vacuum. And if you're letting your homework slide, one day you say, oh boy, the test is tomorrow. I better get all these homework assignments done and study for that test, right? There is some kind of point at which you say, oh, I've really got to catch up. All right, so what's that point for the accountant? Well, that point is going to be the day that they prepare financial statements, right? The end of the year when they have to get their financial statements in order. They can be lazy about journal entries, and it happens. Trust me, companies are lazy about journal entries. But when it comes time to prepare the financial statements, everything has to be perfect. So at that point, they will have to catch up on all of the entries that they missed. Okay, so let's redo example 2, something very similar, but a little more realistic. An online video streaming service received $24 cash in advance from a customer for 12 months of their service in July. No adjustment has been made since. So what this means is that they've been skipping this journal entry. So no adjustment means they haven't been doing these journal entries to update anything. They did this entry back when the cash was received, but since then they've done nothing. By December 31st, the subscriber has watched the service for 5 months. What adjustment needs to be made? Okay, so now it's December 31st, and we need to update everything because we're going to make our financial statements. And the subscriber has watched the service for 5 months. That means we've missed doing the journal entry for 5 months. So we've got to fix it. That's what we mean by adjustment. We're going to fix this and get it done. Okay, now this is the journal entry that we've missed 5 times. So to catch up, I could just do this journal entry 5 times, right? I mean, I could, but that's probably not the most efficient way to do it. And let's be honest, if I'm lazy about this, I'm probably being lazy about a whole bunch of stuff. So I need to get this done as fast as possible so I can get to the other things that need to catch up on as well. All right, so I don't want to do this entry 5 times, but I could do it once for 5 times the amount. So instead of doing 5 entries that record revenue for $2, I can do 1 entry that records revenue for $10, 5 times the amount. And just to show where that $10 came from, right? It's the whole $24 payment divided by the 12 months that were prepaid. And we're multiplying by 5 because 5 months have been earned. So that's where we get our $10, and we can do the entry this way. So it's very typical that companies will do this, right? That they will get lazy about stuff and do it at the end of the year. Every company has what's called a fiscal year end. Fiscal is another fancy word for financial. So it's your financial year end. And that is the day on which your financial statements are prepared every year. Now, a company can choose which fiscal year end they want. When you create your company, you get to decide which day you want to prepare your statements on every year. Now, generally, it doesn't change. You're pretty much deciding forever, but you can choose whichever day you want. So if you want April 24th, then that's going to be your day. Okay? However, it's often easier to have that day at the end of a month, just because a lot of expenses and bills and things are often monthly. So it's typical for a company to choose the end of a month for their fiscal year end. Now, what do you think is the most popular date, the most popular month end for companies to choose for their year end? Well, the answer is December 31st, right? December 31st is the end of the calendar year, so it's convenient to also have that be the end of your financial year. So approximately half of the companies in the US choose December 31st as their fiscal year end. The other half generally choose the end of a different month. So any other month, they might pick the end of that. So for example, the state of California has a year end of June 30th. And that's why whenever they talk about budget issues, they're often talking in June, because that's when they're trying to decide for the budget that begins July 1st. That's why a lot of tax increases and things happen July 1st, so that it starts at the beginning of the fiscal year. San Jose State, because we are a state university, we also have a year end of June 30th, and that's very convenient for the university because that's the end of the academic year, right? So different companies have different needs for their year end. About half of companies pick December 31st. The rest usually pick the end of a different month. Now, regardless of which month you choose, you're going to have to prepare your financial statement. And if you've been skipping journal entries, if you've been a little lazy about your accounting, then you're going to need to catch up at year end. So all of the journal entries that you have to do to catch up at year end are called adjusting entries. Right? So those adjusting entries are the journal entries that you prepare at the end of the year to fix or adjust the accounts to the correct amount so that you can then prepare the correct financial statements. If you know someone who works a job and they've ever said, hey, we're really busy, it's month end, or we're really busy, it's year end, what are they really busy with at month end or year end? They're busy with adjusting entries, right? Work to catch up on all the stuff that they were lazy about during the year. I'm saying it's lazy, but it's very typical. It's pretty standard that companies will do this, that they will just stop these repetitive entries and instead just do one entry at year end and adjust. So that's typically what you see real companies do. Okay, so let's go back to my little table here. We've talked about what happens when we receive cash before there are revenues. And the answer is we have unearned revenues. Okay, let's move on to the next example, the next box. Let's talk about what happens if we have cash before expenses. So cash before revenues means that the customer is paying before we earn the revenue. In this case, cash before expenses means that we're paying before we use something. So we're paying ourselves in advance for something that will be used. Now, again, there are things that typically companies do pay for in advance. Insurance is one example, right? Insurance you always pay for in advance before the coverage begins. And rent, which is what we have here, is another common example of an expense that is typically paid for in advance. Okay, so in this example here, we have a student paying their landlord $9,000 cash for 6 months of rent in advance, right? So imagine they're paying in August for the whole semester. So we're going to give the journal entry for this, but because accounting's so much fun, we're going to do the journal entry for both the student and the landlord. And just for simplicity, we'll say the landlord is the owner of the building. Okay, so we're going to do both journal entries, one for you and one for the landlord. Right? Or I guess where you are the students, right? Okay, so the student is paying cash. So that means cash is decreasing. So we're going to have a credit to cash because it's an asset. Okay, now what is the debit? All right, well, they're paying cash for rent, but is this rent an expense? Well, it's not an expense until it has been used. Have we used the rent? No, we're just starting out. Maybe we haven't even moved in yet. So this is not an expense. Instead, what we have is something called a prepaid expense. So we're going to call it prepaid rent expense. And a prepaid expense is not an actual expense because we haven't used anything yet. It's an asset. Right? If you've paid for something in advance, but you haven't used it yet, well, that is the definition of a future benefit, right? That you have something, you paid for it, but you still haven't used it yet. You get to use it in the future. So for example, if you buy that concert ticket, right? In the future, you get to go attend the concert, right? If you pay for your tuition, well, now you have a whole semester where you're able to attend classes and learn. And in this case, the student has paid their landlord in advance, and now they have a place to live for the next 6 months, right? So paying in advance gives you an asset. Okay? So even though it says expense, the prepaid expense is an asset. All right, now let's think about it from the landlord's point of view. So the landlord isn't paying cash, the landlord is receiving cash. So the landlord is going to have a debit to cash, right? They're receiving it. Now in the landlord's case, they're receiving cash, but have they earned revenue? Nope, not yet. Because in order to earn revenue, they have to let the student live there. And the student hasn't probably even moved in yet. So the landlord has not earned revenue. So for the landlord, it's going to be unearned revenue, right? What we just talked about. They're getting the cash in advance for something that they have not yet provided. Okay. So let's continue on with this example. Let's say that 1 month of the rent term passes. So what's going to happen for both the student and the landlord? All right, well, let's think about it. 1 month of the rent term passes. So that means that the student has been living in the apartment for 1 month. Okay, if they've been living there for 1 month, do they have an expense? Yes, they do. It's not the whole $9,000, but they do have 1 month's worth of expense. Right? Imagine there was a problem and the landlord had to evict everyone and get them out of the apartment building, right? And the student got a refund. They wouldn't get a refund for all 6 months, only the 5 months they hadn't used yet, right? So after 1 month passes, the student has some expense. All right, now remember, expenses are always debits. So for the student, we're going to debit rent expense. And then a credit is going to decrease our prepaid asset. Right? So we're going to credit the prepaid rent expense. Think of it like if you go buy one of those prepaid phones from Walmart, right? What they call a burner phone. So you buy a phone and it's got so many minutes on it of talking, and you use some of those minutes. Well, the prepaid phone is an asset because you have all these minutes to use. But as you use those minutes, the value of the phone is going to drop, right? Because you're using up some of the value. So that's what's happening here. The prepaid asset is decreasing in value. Now, what about the landlord, right? The landlord has unearned revenue, and after a month passes, they've earned some of that revenue. So what's going to happen is they're going to debit or decrease their unearned revenue. Now, in the case of the landlord, they don't have rent expense. They're going to have revenue. As they earn, they're going to record their revenue. So their credit is going to be rent revenue. And, oh, that's very interesting. There we go. All right, so again, you can see here, this is just another example of unearned revenue. But the other side of it, for the customer, in this case the student, right, they prepaid in advance, they have a prepaid expense, and then as they use the prepaid asset, they record the real expense, in this case the rent expense. Now in this example, the amount was $1,500. Where did that come from, right? All right, so that $1,500 comes from a calculation. If I could bring it over, that would be good. Okay, so what we did is we took the full $9,000, that was for 6 months. Right? So we took the $9,000 divided by the 6 months times 1 month, because 1 month of the rent term had passed. That's where we got our $1,500. Now, as you can imagine, right, students can be lazy too, not just business people. So it's fairly common for people to be lazy about something like this because, again, it's a repetitive entry. Every month you've got to do the exact same entry. All right, so let's do a slightly different, more realistic version of this question. A student pays the landlord $9,000 cash for 6 months of rent in advance on August 31st. No adjustment has been made since. What adjustment must be made at December 31st? Okay, so no adjustment has been made since means they haven't been doing this, right? So they have not been recording this monthly stuff. All right, but it's now year end, it's December 31st. What do they have to do to catch up and fix this? Okay? And we're going to just do this for the student only. Okay, so they have missed this entry 4 times. Now, how do I know it's 4 times? Well, we have to count. So they paid in advance on August 31st. So since that time, they have used September, October, November, and December. Okay? So they've used those 4 months. So we should really be doing this entry 4 times. But, we're lazy. So what we're going to do is we're going to do this entry once, but for 4 times the amount. So what we're going to end up doing is we're going to debit rent expense and credit prepaid rent expense for $6,000. All right, so where does $6,000 come from? Right, $6,000 is the total $9,000 that the student paid in advance divided by the 6 months they prepaid multiplied by the 4 months used, right? September, October, November, December. All right, so let's go back to our little table here. Okay. We have learned that if you pay cash before you use the expense, it's called a prepaid expense. All right, now let's just finish filling this in. We're here. All right, let's talk about the last situation, cash after expenses. Now, we have talked about this already, right? We've talked about what happens if we have an expense, but we haven't paid for it yet, right? We get that utility bill, we've used the electricity or the phone or the internet, but we haven't paid for it yet. So what do we have? We have an account payable. And of course, again, accountants have to have a fancy term for this. Sometimes this is called accrued expenses. You'll see accrued expenses a little more often than accrued revenue. Sometimes it's just used as another name for different kinds of, short bills that we have to pay. But again, it's more of a fancy term. Essentially, accrued expenses are accounts payable. So we've done that before. I don't want to do it again because, that would kind of be boring. So let's do something different. Let's talk about salary. So let's take a look here. Let's say that a company's employees get paid a total of $10,000 salary every Friday. All right, so what is the journal entry to record salary on Friday? Right? So the employees get paid on Friday. It's a 5-day work week, right? They work Monday through Friday, and Friday they get paid $10,000. So what's involved there? Well, they're paying for salaries, and they've already worked, so it's going to be salaries expense. And of course, an expense is always a debit. And then they're paying them, so that means cash is going down, so the credit will be cash. All right. Now, that's how it works for 51 weeks of the year. But the last week of the year is the week that financial statements are prepared. Now, are financial statements always going to be prepared on a Friday? Nope. That last day of the month can fall any day. So Let's see what happens if it's not Friday. The company prepares financial statements on December 31st. This year, December 31st is a Wednesday. All right, so what adjustment needs to be made? All right, so the problem is that the last time the employees were paid was last Friday. But what have they done this week? They worked Monday, Tuesday, and Wednesday. And Monday, Tuesday, and Wednesday were in December. That means that they were earning revenues in December. So in order to properly match the expenses and the revenues together, in order to get that accurate calculation of profit, we need to make sure that the salary expense from Monday, Tuesday, and Wednesday is recorded in December. So even though it's not Friday, even though it's not the day the employees are getting paid, because it is the year end, we have to record those 3 days of salary expense. So what we're going to do on Wednesday, December 31st, is we are going to record a debit, remember expenses are debited, to salary expense for the 3 days. All right, so how did I calculate $6,000? Right? It's 3 days worth. So here we've got $6,000, right? There we go, which is the $10,000 for the whole week divided by 5 days. It's a 5-day work week, right? Monday through Friday, times the 3 days that the employees worked. Monday, Tuesday, Wednesday. Okay, now, have we paid for those salaries yet? The answer is no, we're not going to pay till Friday. Even though it's New Year's Eve, we're going to be cheap. We're going to wait until the end of the week, right? So what do we have here to credit? We have some kind of payable. Now, normally you would probably call this an account payable, and that would be perfectly fine. On a test, I would accept something like that. But most companies actually separate out salaries because salaries aren't really like a bill. They usually put salaries in its own account. So typically what you'll see with a real company is they will call this salary payable. So it's just like accounts payable, it's just this one is specifically for salaries. So we have the expense and we have a payable, right? So this is what happens when we have the expense, but we haven't paid for it yet. We have to set up a payable, a liability. Okay. Now, this isn't the end of it because a couple days later, it's Friday and the employees get paid. So we're going to give the company's journal entry to record the payment of those salaries on Friday, January 2nd. Okay, so what happens on Friday the 2nd? All right, well, the obvious thing is that we're going to pay cash, right? We have to pay the employees. So let's leave a couple lines and we're going to credit or decrease cash for $10,000. Right? We're paying the full week of salary, right? Even though we did an entry already, there was no cash in there, right? So we have to pay the full week to our employees, all $10,000. All right, so what are we debiting? Well, first, we've got the salary payable, right? Because that salary payable, that liability that we set up, now we're paying it off. So we get to debit that. But there's a problem. The cash we're paying is not the same amount as the liability. Clearly, we're missing something. There's some other debit that belongs in here that we haven't put in yet. What is it? Well, the answer is it's more salary expense. All right, now why do I need more salary expense? I mean, I already recorded salary expense back here. Well, the reason I need more is because I only recorded 3 days, Monday, Tuesday, Wednesday. And right now it's Friday. Looks like I didn't put the date in there. Let's get that in. It's Friday. So what happened? the employees also worked on Thursday and Friday. And Thursday and Friday, they're also getting paid for that. So we have 2 more days of salary expense in January. So what did we do here? We took that whole week of expense and we cut it up into December and January. We said, okay, the first 3 days are in December and they are a December expense. But the last 2 days, Thursday and Friday, they are in January and they are a January expense, right? That way, the salary from December is used and put against revenues from December on the December income statement. And the salary from January, that expense is put against January revenues and on the January income statement. And that's how we make sure we're calculating profit correctly. All right, last thing here. How did I calculate the $4,000? Well, the $4,000 was calculated as the $10,000 for the whole week, right? It's a 5-day work week times the 2 days that they worked in January, Thursday and Friday. So what's the overall effect of both of these? Well, the salary payable, I have a credit, I have a debit, that cancels out, right? Okay. So there's no salary payable after both these entries are completed. I have cash of $10,000. That's the same cash of $10,000 I had here. And for salary expense, I have salary expense of $4,000 and salary expense of $6,000, which is a total of salary expense of $10,000. So what I have done is I've actually taken this entry, the regular simple one from a normal week, and I've broken it up into 2 pieces. And the reason I had to break it up was because of the year end. Because that year end came in the middle, I have to have this breakup, right? So the year end can always cause complications. There are always adjustments and things that need to be made. So this is an example of how that would work. So next lecture, we're actually going to be talking more about these kinds of adjustments and adjusting entries that take place at the end of the year, things that companies have to fix in order to get their financial statements perfect. There are just a couple more concepts that I'd like to talk about today, though. So just as a couple of simple ones. First, I want to talk about the concept of conservatism. Now, people say that accountants are conservative. Does that mean that they all wear navy blue and vote Republican? I mean, maybe, but that's not what they mean when they say that accountants are conservative. What it means is that accountants are conservative financially, right? So what does that mean? It means that when accountants have a choice of how to present numbers, they will voluntarily go with the way that makes things look worse. So accountants don't want to make things look too good. If they have the choice, they want to make things look worse. Now, why? Why are accountants doing that? Are they just mean? No, accountants aren't mean. But they're doing it to counteract management. If you remember in the first lecture, we talked about neutrality, right? We said that financial statements are reliable because there is no bias. They are neutral. Now, the problem is that managers generally have a positive bias, right? A manager for a company wants the company to do well. They want assets and revenues to be higher, and they want expenses and liabilities to be lower. And even if they don't consciously act on that, subconsciously that's in their minds, and it does impact the company's results. So what does the accountant do to make sure that there's no positive bias in the accounting numbers? The answer is they are conservative. They build a negative bias, they build conservatism into the rules so that when that negative bias meets management's positive bias, it should cancel out and result in neutral financial statements. So the idea with conservatism is that it is a pessimistic viewpoint that's built into the accounting rules, built into GAAP, that creates a negative bias, and that counteracts management's positive bias. All right, the basic idea of conservatism is that we want to prevent overstatement of assets and revenues and prevent understatement of liabilities and expenses. And we're going to see some various examples as we go through the course of times in the rules where we're clearly going with the thing that makes stuff look worse. We're going with the method that is more conservative. So we'll see some examples of that as the course goes on. Okay, the last thing I want to talk about today is categorizing assets and liabilities. So it turns out that assets and liabilities are actually subcategorized on the financial statements, on the balance sheet, because there are so many of them. When you look at a company's balance sheet, right, a real company is going to have hundreds of different assets and hundreds of different liabilities. And sometimes they'll just combine them together into one. For example, saying utilities instead of having electricity, water, internet, garbage, right? They'll just say utilities. Sometimes they combine, but they also subcategorize the assets and liabilities. So assets are subcategorized into current assets and long-term assets. Now, an asset is a future benefit. So a current asset is an asset whose benefit will be used up within 1 year. And a long-term asset is an asset whose benefit will be fully used in more than 1 year. So current means that we're using it up within the next year. Long-term means it's going to take more than a year to fully use it up. Okay, so let's think about the assets that we know. Now, which assets, right, are going to be current? Well, something like cash is the ultimate current asset because cash is used up very, very quickly, right? We're using cash every single day, hopefully also replenishing it, but we're always spending cash. It gets used very fast. Accounts receivable. That's another example of a current asset, right? Because we have these customers who owe us money. Are you going to wait more than a year for your customer to pay you? Probably not, right? So accounts receivable, we're going to expect to collect those well within 1 year. Supplies are another example of a current asset because I know you can go to Costco and you can get that like barrel of mustard that will last for 10 years. Typically, though, most people don't buy supplies longer than a year in advance, right? So even if I go crazy because there's a pandemic and I need toilet paper, I'm probably not buying more than a few months worth of toilet paper at once, even if I'm hoarding, right? So supplies, typically we have less than a year's worth on hand. And so we'll use that up within a year. Okay. Another type of current asset, something we just discussed today, are those prepaid expenses. It is possible to pay for multiple years in advance, but typically when people pay for something in advance, it's less than a year's worth. So I pay for 6 months of insurance or 1 month of rent, or I might pay for 1 year in advance of my streaming service, typically not more than that. So prepaid expenses are usually current as well. Okay, so what's long-term? All the big stuff is long-term, right? What lasts longer than a year? Well, land lasts longer than a year. Buildings last longer than a year. Equipment or machinery They last longer than a year. Furniture, right? Vehicles, right? Mobile phones, computers, all that stuff lasts longer than a year. So that's going to be in the long-term asset category. Okay, now liabilities are also broken up into the same two categories. We have current liabilities and long-term liabilities. Now, a current asset is an asset whose benefits will be used up within 1 year. So what's a current liability? Well, a current liability is a liability that will be paid within 1 year. Okay. And a long-term liability is a liability that will be fully paid in more than 1 year. So again, we have that 1 year designation. It's just the difference is instead of benefits, it's when will it be paid. Well, the most common liability is also a current liability. That's accounts payable. I don't think the electric company is going to wait more than a year for me to pay them. If I did take that long, I have a feeling my electricity would be shut off, right? So typically, it takes a while, it's pretty fast to pay those bills. Also, the thing we just discussed, salary payable. My employees are not going to be waiting more than a year to get paid. I might be a little late, but it's not going to be that long. Okay? And another current liability is usually unearned revenue. Because when customers pay in advance, right, again, typically we're not paying for more than a year's worth of stuff. So that customer is probably not paying for more than a year. I mean, it can happen. There are situations where customers will pay for more than a year in advance, but that's not the common thing. So most unearned revenue would be current. Okay, so what's a long-term liability? Well, that would be something that's paid in more than a year. So probably most of your loans, like your student loans, for example, or if you have a car loan, those are probably more than 1 year. Yes, you might be paying on them, but they won't be fully paid up for more than a year. You have to be careful with liabilities, though, because let's say I have a 30-year loan. For the first 29 years, that loan will be long-term. Right? But in the last year, the 30th year, it's going to move up and become current because in that last year, it's going to be paid within a year. So all the long-term liabilities will eventually be moving to current in their final year. Okay, so that's, I think, enough for today. So I'll give you the homework assignments, and this is due on Tuesday. So from last time, you had Chapter 1, questions 9 and 10, and then question 5 from Chapter 2. And now from Chapter 2, we've been delving more into that. I'd also like you to do questions 1, 2, and 3. So these will be due next week. So we'll talk more about these adjusting entries next lecture. And until then, stay well.